The Fed kind of surprised some people with the size of the rate cut in September. Many were predicting 25 basis point cut, and they came in with 50 points. Since then, we've had a very aggressive, a very robust jobs growth number. There was some thinking that maybe the Fed had a 50 basis point cut because the summer jobs numbers didn't look very good. It was a particularly bad number in July. So do you think that with the evidence that's come in since, well, let me just ask, is the 50 point, the size of the 50 point basis, the 50 point basis cut surprise you?
I was mildly surprised, although I was at the Jackson program that the Federal Reserve Bank of Kansas City has in the summer, in August, when Chairman Powell pretty much said we're going to cut rates, and was a very dovish speech. So I think it wasn't entirely a shock, but it was a bit of a surprise because, number one, the economy even before that was running second quarter 3%. Third quarter was looking strong even then. And I think the fourth quarter now is still starting off fairly well. So whether there was a need for a 50 base cut or it served a good purpose is out for debate. I wouldn't personally have preferred a 25 basis point cut if there was going to be a cut. And I could argue that there should not have been a cut at all, given the strength of the economy. I think one of the risk of saying you're data dependent month to month is you move as volatilely as the data. Because in July, we had some employment number adjustments that scared the market, a big adjustment down in terms of the number of employed. And even though there was a clear difference between the so-called household and the employment surveys, they still thought it was a surprise. And unfortunately, the market then said, oh, we're going to have an emergency cut. And I think that helped persuade maybe the Fed in September to go ahead with the 50 basis point cut. But the fact of the matter is the economy then and the economy now is moving fairly well. And we'll have to follow that forward. I want to take just a moment. One of the things if it would be useful is if they took a longer term view of the outlook in terms of their interest rates. For example, real interest rates are, if you say they're now 4.75%, given the recent cut, the nominal rate is 4.75 around that number, and inflation is still 3%. Let's be just the round numbers off. You have real rates then at about 1.5%. That's pretty, unless I did my arithmetic wrong. Regardless, that's pretty mildly restrictive, if restrictive at all, given where inflation continues to be. Now, if you say inflation's less than that, then the rates are higher. But I would say that we're not in a shall I say, a strong restrictive policy position. It's mildly restrictive at most. Inflation's still above the 2% target. So you can make a case for waiting and seeing. And that, I think, will be a discussion item now as they look to the November meeting.